What is up, you guys? Thanks so much for tuning in. My name is Dimitri Christie. I'm a real estate broker, investor, and mentor. And today I want to talk to you just about real estate investing and why I think more people should get into buying real estate, why I got into buying real estate, and the true benefits and the ways that you can invest, the different strategies to actually be successful, as well as I'm going to lay down some of the foundational pieces you need to build $1 million portfolio. I really started investing in real estate because I was tired of my W-2. I didn't want to work for someone until I retired, and I wanted to provide some additional financial freedom and time freedom for not only myself, but my family and those around me. If you're someone like me who, graduated college, went to work a job, started working in corporate, and really were feeling unfulfilled for your life, I mean, this video is definitely for you. The top four ways that I have chosen to invest in real estate have been the house hack, buy and hold rentals, fix and flips, and the BRRRR strategy. And there are a whole number of offshoots that come off of those and tactics and strategies that you can utilize for each one of those four. Really, the whole goal in investing in real estate is to build long-term wealth. There's a beautiful thing that you can benefit off of the cash flow, but oftentimes the cash flow is not going to retire you immediately. It's not going to turn you into a millionaire overnight unless you do some massive multifamily or commercial property. But you always have to start somewhere, and getting to know the ins and outs of real estate, what you enjoy, what you're passionate about, what truly is a good use of your money, you can only really experience from learning and watching videos like this. So this is a great first step. But in reality is actually through experiencing it, buying real estate properties, doing deals, and figuring out what you have a taste for. So the number one way that I really recommend every single person to start investing in real estate, if you can, if you're in a market where you can afford to buy a property, a primary residence would be exactly that, to buy your own home. You can utilize a first-time homebuyer loan, which is typically a FHA mortgage, and you can put down as little as 3.5% of the purchase price. And this is a very highly valuable way that you can leverage this program to actually hold an asset of real estate and benefit from the appreciation that comes along with it. The biggest way that real estate makes millionaires is by those people, those investors holding properties, and those properties gaining value over time with the market, with inflation. Then the amount that they own of the property turns out to be hundreds of thousands of dollars into the millions. And so the first route, as I mentioned, is buying your own primary residence using an FHA loan. The coolest way to go about this is a strategy called house hacking. So buying a property that's a single family residence where you can rent out the rooms to roommates and friends, potentially Airbnb the rooms, and have those other people cover your expenses. And in some awesome cases, you actually cash flow as if you were holding a rental property. You cover all your expenses, you pay your utilities, mortgage, insurance, everything like that, and then you might have some money left over. And so house hacking not only is great for single family homes, but you can use a FHA mortgage to buy a 1, 2, 3, up to 4 unit property. And you can live in one unit if you have a multi-unit 2 to 4 and rent out those others. The other cool thing is that the FHA mortgage only requires you to live in that property for 1 year. So you can even buy a property, if it's single family or multifamily, doesn't matter, live in it for a year, and then move out and buy another property, go rent a property, just depending on your financial situation. And there you go. You have a solid foundational piece for your real estate portfolio. The other beautiful thing about owning your own residence are the tax benefits. And tax benefits are a huge component to real estate investing because it offers you advantages that not other real estate assets, but other assets in general, like the stock market, don't afford you. So when you sell your primary residence, let's say a few years down the line, as long as you've lived in it 2 out of the last 5 years. So that could be 1, 2 years, and then you sell it. You could live in it the first year, move out, move back in year 3 or 4 or whatever, and then sell it at that point. As long as you live in it for 2 out of the last 5 years prior to your sale, if you're filing your taxes, if you're a single person filing your taxes, you can take up to $250,000 of profits on your sale tax free. Now, if you're married and you're filing jointly, you can actually take up to $500,000 tax free. So, what I see a number of investors do who don't really want to do some of these other strategies that I'm about to mention, what they'll do is every 2 years, they'll buy a home, live in it, sell it, take those profits, buy another one, and the money just multiplies. So that's a great strategy to build a foundational piece to your portfolio, to make money tax free, and also at the same time by house hacking, as I mentioned, covering your expenses. If you're making money through a job and you don't have any housing expenses, typical Americans have between 30 to 50% even of their monthly pay goes right to housing. So if you eliminate that, not only are you holding an asset, but you're also creating additional income that you are making, right? But you're not having to pay to cover your housing expenses. The second strategy is the tried and true rental strategy. It's called buy and hold rentals. Essentially, you buy a rental property and you want to make sure it cash flows. That way the tenants are paying your mortgage, covering their expenses, and every month that you own this property, you're owning more of it because your mortgage includes principal, taxes, insurance, and interest. It's actually principal, interest, taxes, and what's it called? Principal, interest, taxes, and insurance. Those are the 4 components to your mortgage. And every month, your principal is actually how much you owe to the bank of that property. And every time you pay your mortgage, that dollar amount is coming down. So you actually own more of the property. The second part of owning a real estate asset is the appreciation. So the value it gains over time through the market increasing. The third is going to be your cash flow. So how much money you get every month. That is the difference between your rent that you're charging your tenants, all your expenses, and then your mortgage, right? So if you are renting a property for $1,500 and your mortgage and all your expenses are $1,000, then you're pocketing $500 a month. These buy and hold properties, you can purchase them with conventional loans through banks, a DSCR loan, which is a debt service coverage ratio loan. These loans, the DSCR loan, does not base off of your personal income. You need to have good credit, at least the 680 usually. Sometimes they can go down to 640. But if you have a 680 credit score and the property cash flows, then you're set up in a good position. They'll lend you, even if you don't make a whole lot or your debt to income ratio is through the roof. Maybe you have a car payment, maybe you have student loans, maybe you have credit card loans, things like that. So you don't have to worry about that with a DSCR loan versus a conventional loan, which is going to take your personal finances into account. And the only thing about the DSCR loan versus the conventional is that you likely have a higher interest rate. But at the same time, if the property is cash flowing and you can make the numbers work, it's great. You can scale your you can scale your portfolio unlimitedly, if that's even a word, through using DSCR loans. You need 20% down minimum for these 2 types of loans to buy a rental property. But this is a great way because you benefit through all of those advantages that real estate provides, as well as the tax advantages. So when you own a rental property, any expenses like property management or any maintenance you make to it, you can deduct from the rental income on your taxes. So oftentimes the rental income actually ends up being reduced on your tax liabilities because of all your expenses, which is great. And so the third way that you can invest in real estate is doing a fix and flip. And a fix and flip property is going to be something that you would just really get a massive influx of cash through the sale. So what's the idea here? You find a property that it needs work, Maybe it's on the market, maybe it's off the market, and you take out a hard money loan. These are the types of loans that you're going to use for a fix and flip and the next strategy, the BRRRR. So let's stick to the fix and flip for now. You find a property that needs work and you understand, okay, once I fix this up, what is the value going to be after the fact, which is going to be the amount you can sell it for. And as long as you buy it with a general rule of 70% of the ARV, which is after repair value, then you're going to make money. 70% of the ARV minus the amount of money you need to fix it up. As long as you have that formula in place, many investors do 60%, sometimes 65%. The lower you can go, the higher margin you'll have. Let me break it down for you in case that was a little bit confusing. So if you have a $100,000 property, after you fix it up, it's going to be worth $100,000. Then you want to purchase that property at $70,000, but then you actually want to purchase it even lower because you're going to have to put money into the work that needs to be done, right? So the work that needs to be done, let's say is $20,000. Then you'll want to buy that property at $50,000. That way you have the 70% from the 100 is 70,000 minus the 20 is 50,000. And there you go. There's your margins. You have a 30% margin on your investments, basically a profitability, a profit margin. And once you sell it, you're about $70,000 in and you make 30. These fix and flips are often quick turnarounds, anywhere between 3 to 6 months, depending on the project. Sometimes you can do it faster. If it's a larger project, sometimes it takes longer. And you would use a hard money loan, as I mentioned. What's a hard money loan? It kind of sounds scary, and that's oftentimes because people don't understand it. So a hard money loan is a short-term loan. These loans are anywhere between 6 months to a year, and most hard money lenders will offer you 90% of the purchase price plus 100% of the rehab in financing. There are fees, and they charge interest only on the loans. So every month you're going to be paying only interest. Your principal will not go down as it would in the previous examples I gave of paying down your principal every month. But it's because you're going for that quick hit after for the cash influx, the big windfall. So a hard money loan, you'd pay origination fees, you'd pay some fees up front in order to just get the loan. But on that $50,000 purchase, you'd only have a $5,000 down payment. Even though you're buying a $50,000 property, you're putting $20,000 in work, your down payment would be $5,000 plus the fees. Oftentimes it comes out to be anywhere between 15 to 17.5% down overall that you need. And again, every month you're going to be paying interest only payments, but you can do the work and then request draws on the work that you've done, and the lender will send you the money to pay the contractors, to pay your credit card if you're funding the renovation on a credit card, or even if you have the cash available. This is a great way to leverage a loan in order to have your cash still in the bank, protect it, and then continue to do work. So fix and flip oftentimes is a great way to multiply your funds, because as I just mentioned, let's say you're starting with $10,000, right? That would be 20% on the $50,000 purchase. And I said you only need between 10 to 17.5, but let's say it's 20. Well, this means that you're going to be doing a deal where you have $10,000 invested and you're going to profit 30 on the back end. So, I mean, come on, who would not want to do that in a matter of 4 months is the typical flip. That's a salary for many people in America. Let's say you do 2 of those a year, you're at $60,000 profit. And the more that you do, the better you're going to get. Not only in your processes, but also in finding deals, networking with people, maybe getting better numbers and quotes from contractors because they know that they have steady work coming from you. And this is a beautiful thing that I love fix and flips. One of my students right now, I'm helping him through a fix and flip, and his out of pocket was only $17,700. and he's slotted to make anywhere between 47 to 67, just depending on the market and what he decides to sell it at. So that's the fix and flip, where you would multiply your money very quickly. But the thing is there's a little bit more risk. Oftentimes, budgets go over what you originally projected, which is why it's very important to be conservative on your budget. If a contractor quotes you 55, make sure that you have a buffer and potentially budget 75 for your budget. Also, the timeline typically is longer than you expected. If a contractor says it's going to take 3 to 4 weeks, I would budget 2 months, honestly. If things happen, maybe there's material shortages, maybe there's surprises that they come about. So you always want to be conservative when you're analyzing investment properties. Then the last one. The last one is the BRRRR strategy. So what does BRRRR stand for? BRRRR stands for buy, renovate, rent, refinance, and then sometimes people throw an additional R because you want to repeat. You can just keep washing your money through this process. How does this work? You're going to look for a property as you would for a fix and flip, something that needs work, something you can get a great deal on, and then you're going to fix it up just as you would in the fix and flip. You're likely using a hard money loan for the BRRRR strategy. And then once you fix it up, rather than listing it on the market to sell, you're actually going to get a tenant in there. You can likely work with a property management company, which I suggest, especially if you're a first-time investor. Even if you're an experienced investor like myself, I really dislike managing properties because there's just a lot of headaches that go with it. You have to qualify tenants. You have to do showings. You have to secure security deposits, negotiate leases, enforce those leases. Then once the tenant is in there, you have to keep up with maintenance. If you hire a professional property management company, their typical fees are going to be anywhere between 8 to 12%. If you have, and the average rate is really 10%. So buffering 10% of your monthly rent, if you're renting it for $1,000, you're paying your property manager $100 a month, which at the end of the day, for the headache and everything that goes into it, is completely worth it. This is going to be for a rental property. It can apply to a buy and hold, and then this BRRRR strategy we're talking about, which you turn from a property similar to a fix and flip that needs work into a buy and hold rental. Then, like I said, instead of putting it on the market, you're going to take it to a lender and say, hey, I'd like to refinance my hard money loan at the new value of this property, which I've just fixed up and increased the value. And so you'll take out a loan, conventional or a DSCR loan on your refinance. And they'll typically do anywhere between 65 to 80% cash out refinance. And this money that you cash out is actually tax-free. So for example, I did a BRRRR strategy here in North Carolina, and I was originally in the property. We bought it at 78. We put about $9,000, $10,000 into it. And the value after we fixed it up was $158,000. So we basically doubled the value with only $9,000 to $10,000 of renovation investment. So what the bank did was said, okay, and we took a 65% cash out refinance. It turned out to be about $103,000. So the difference between that, let's say $88,000 and the 103 was our tax-free cash out that we got to take home. It's about $15,000 in this round number example I'm giving. But the reality is that we actually cashed out $38,500, and that's because we put a down payment originally, so we didn't actually owe 78. We owed less than that, and we recouped our initial investment as well as $19,000 tax-free. Because when you refinance and you do a cash out, the difference that you get is not taxable because you're taking a loan. So it's not income, it's actually a loan. And then you have a rental property on a long-term loan and it cash flows. So that property is cash flowing $200 a month. We're about to go up in rent and we'll cash flow even more. Then additionally, I mentioned it was valued at $158,000. So if our loan was 103, then we left $55,000 in equity, which went straight to our net worth. And that value is just being held there. So if we decided to sell, we'd have a check for about $50,000. So these are the 4 strategies that I love in real estate that I think every investor should be knowledgeable on and maybe dip their toes to see what they like. The buy and hold and the house hacking methods are going to be a lot more hands-off because you're not actively managing renovation projects. You're not trusting in contractors to do the work properly and on time. So the buy and hold and house hacking are less risk than the BRRRR strategy and the fix and flip, but the upside on those other 2 immediately and in the long term are much different. And it just depends on your risk tolerance. It depends on the time that you have to invest in your real estate business. And some other ways that I love to share with you about how to source properties are you can look on Craigslist, you can look on Facebook, the MLS, if you get a broker to put you on an automatic search with your criteria in the area that you're looking for, be happy to help you out with that if that's something you're interested in. As well as there's a great website with off-market properties, very similar to Realtor.com or Zillow, that's called Investor Lift. And all of those properties on there are off-market. They're listed by wholesalers. And what is a wholesaler? A wholesaler is someone who contacts a seller directly, a property owner who may be wanting to sell, maybe not actively, but they offer them a contract. And then this wholesaler has a great deal and offers it to investors who want to buy rental properties, who want to buy fix and flips and do the BRRRR strategy. What they do is they take that contract that they have with the owner and they essentially assign that contract to an end buyer. The assignment is of the contract. They don't ever actually own the property. And this is a great way I found a number of my properties. I found them, again, on Craigslist, on Facebook. I've gone to local real estate meetups, which I highly recommend you to do as well. You can look them up if you Google biggerpockets.com meetups, and you can search in your area, where's my local real estate meetups? There's likely multiple going on every single month where you can meet other investors. They typically have talks where you can go and learn from these investors. They give presentations. There's great networking opportunities, but also there's typically a number of wholesalers who attend these meetups that you can network with and get on their email list. Provide them with the markets you're looking for, your buy box, which is essentially your criteria for the types of properties that you're looking for, and you can source properties in this way. Finding lenders is fairly easy, honestly. You can ask around at the meetups. You can ask in Facebook groups. I would search the city you're looking for, real estate investing, the city you're looking in, wholesaling. That's what you would search on Facebook in order to find and network with other people, with other professionals in the area. That way you can build out your team. That way you can actually find properties and start to grow your real estate network. Sourcing properties is one thing, but then you also have to consider qualifying contractors. You have to consider qualifying property managers. And the number one thing I would say is you want to make sure that they have great communication, because communication is key. That's a formal way to build trust, is if someone can respond to you in a timely manner, but not only timely, professional manner. There are other factors as well that I teach my mentoring students. And if this is something you're interested in getting mentored to buy your first investment property, I help first-time flippers, first-time investors make sure that they invest in a property that they're confident in, not just a property, but a market, as well as making sure that it's profitable. If you're interested to learn more, let's talk and book a call. Go ahead and click the link in the description. Book a call with me. Be happy to talk to you about my real estate mentorship program, where I teach first-time investors how to profitably and confidently buy investment properties. I teach them on a one-on-one basis as well as a group basis, where I provide tailored strategies. And it's me. I don't hand you off to a team or other coaches or sub-coaches or other random people. You'd be working directly with me to work on a tailored strategy that fits you, your time commitment, availability, your financial ability. Typically, you need between $20,000, $30,000 to $50,000 in order to start with good credit. As I mentioned earlier on, about a 680, and That way you can really start your portfolio. The earlier you start, the better. The real estate market has only increased. People who worry about a crash, who were worrying about the crash in 2008, wish they bought more in 2008. We're at an all-time high right now in 2024 for the real estate market, and there may be dips, there may be markets that are going down, but as long as you're looking at business development, as long as you're looking at population growth, crime rates, schools that are in the area, other businesses that are coming to the area and investing money. If the city is investing in their infrastructure, if they're giving tax breaks to businesses to build out and incentivize them to hire more workers, that's a terrific market to invest in. And you want to make sure that it's a landlord friendly state. Now, you may not live in a landlord friendly state, so the house hacking method might be a great way to get into investments. But if you are looking to buy a property that's a buy and hold, you're going to want to make sure that it's a landlord friendly state. States like North Carolina, where I am, are incredible. States like Alabama and Arkansas and Ohio and some other states that have laws that make it easy for landlords to win when there's conflict between tenants and landlords. Likely a tenant isn't paying, maybe you have squatters. These are worst case scenarios, which is why it's so pivotal to have a great property management company. But you're going to want to make sure that you're investing in a landlord friendly state, which we can review, we can laser in on. And if you're in a market that's more expensive, like New York or Los Angeles, Bay Area, California, these different markets that are really expensive to buy, then your money will go a lot further if you're investing out of state. I moved from Texas to North Carolina because the property taxes are very low here, but they were very high in Texas. So property taxes eat into your profits. And if you're in a place like Texas, they're about 2.5%. They could be more depending on your area. And they're reassessed, which means they get reviewed and updated every single year. In North Carolina, I love it because we have property taxes that are about 1%, if not lower in a lot of areas, and they only get reassessed every 4 years. So you can really analyze your properties and strategically figure out, okay, what is it going to look like for the next 4 years? If you're in the middle of a cycle, let's say, what is it going to look like for the next 2 years? And then even then, you have time for rents to increase along the way to keep up, which is tough in a market like Texas, let's say, where they're reassessed every year. You have to pay them regardless. Even if rental rates aren't keeping up, then your numbers are likely going to get crunched. If this is something that interests you, make sure you message me or set up a call with me in the description below. That way we can get talking. That way we can talk about strategy and get you started investing in real estate. I look forward to talking to you soon.